what's happening in the regulatory space. We also hope to have a deep dive into one of the topics that might be of interest to many of the founders. The reason we picked lending this time was Saurabh Raj, one of the founders from Mumbai. He's ex-IIT Delhi. He's very much active in the embedded finance, DeFi, Web3, blockchain area. He was the one who was very, very keen to dive into this. And that's how we started off with this topic. Unfortunately, he was going to join us. Unfortunately, he's not joining us today because, like many fintechs, if somebody is going to give you funds and they ask you to come and do the presentation, that's where you go. So he's right now in Dubai doing his presentation to all grants. And he's very, very hopeful that his two projects will be seen very favorably. So let me now introduce Teresa Karunakaran. I have known her for a number of years now. She was with RBI throughout her career. She's presented to the finance ministers, different finance ministers at different points in time. She's dealt with regulators around the world. Post her retirement from RBI, she has worked in a number of banks, a couple of them. One of them was Deutsche Bank. That's how I know her really well. And her advice has always been very pragmatic. How do you find solutions, not a theoretical, this is what we have to do theoretically. So which is where I've always found her counsel really, really helpful. She's now with an advisory firm which provides compliance advisory. And feel free to share more about that. She also teaches or provides sessions at the MIT University. She's really, really keen to develop this ecosystem and in a safe way. She's also involved or part of the counterterrorism conferences. So I think she has lots of insight into how the world is evolving. So over to Teresa. Before she does that, a bit of context. The fintech ecosystem is really large. And one of the things that TiE Bangalore wants to do is provide different lenses by which the startups and those engaging in this ecosystem can successfully deliver to that 1 trillion target or 200 billion revenues that we are expecting by the end of this decade. In order to do that, one of the guardrails is obviously regulatory. So therefore, we felt it is essential to have that in place. We will be having a monthly session, and we hope that you'll join us for the next one on the 19th of January, which will be on digital currency, blockchain, and a whole bunch of related topics. Feel free to ping us if you have other topics that you want us to take up. But at this point, I will then hand it over to Teresa, who will set the context, deep dive into lending and regulatory issues. And then anyone who's there, feel free to share your views, because the objective here is for Teresa also to get a different perspective of how the founders look at this topic. And therefore, if we have an opportunity to take things back to RBI, we can do so. We have actually invited RBI's Innovation Hub, people from there. So not sure whether they've joined or not, but we hope that, with the fact that it's on YouTube, many of the founders and our ecosystem partners can definitely get some benefit from these sessions. Over to you, Teresa.
Hi, good evening. It's great to be here to interact with you people on basically on the regulatory kind of perspective, the regulatory scenario, what's developing, and also a deep dive or deep insight on the guidelines on digital lending, which directly affects a whole lot of fintech community. To begin with, we are at a momentous stage. December 1st is a historic date for the reason that India has taken over the presidency of the G20 nations, and that's a momentous occasion. And also the launch of the digital rupee for the retail transactions. That's also a momentous incident which has taken place, or not rather incident, I would say is an event that has taken place. and which we are legitimately proud of, because it's followed in quick succession to the central bank digital currency in wholesale transactions in government securities, which was launched on January 1st. And this helped, to make the ease of settlement between banks, particularly in wholesale secondary market, the government securities. And it instead of transacting in the current accounts of banks with the RBI, it was through the central bank digital currency, which was being the settlements were being done. That was on November 1st, where you had 9 banks. And these were largely the major banks like SBI, Bank of Baroda, Union Bank, ICICI Bank, HDFC, etc., who were involved in that wholesale e-rupee transactions. And now, the other important event which took place today was the launch of the digital rupee for the retail transactions. Here, basically, it is the 4 banks which are catering to the requirements of 4 cities, and these are ICICI Bank, IDFC, Yes Bank, and SBI. And in the second, this is mainly in Mumbai, Bangalore, and Bhubaneswar and New Delhi. In the second phase, there would be more banks joining in: Union Bank, Bank of Baroda, and HDFC Bank, Kotak, etc. And this would be going to other cities like Hyderabad. Then you find Kochi there, and Gangtok, Guwahati, and other cities which would also be part of that system. And here you have both retail transactions for the retail customer being facilitated through mobile wallets, where you download the e-rupee. The facility allows you to download an app, and it is stored in your mobile wallet, and the rupee is stored in your mobile wallet, and you can use it for transactions, for retail transactions, and also with the merchants using a QR code. So this facilitates the entire transactions in the digital currency. Now, this is something, a concern which has come up. I don't want to take up too much time on this, because as Sandhya has promised that this is for a later date, but then I needed to set a little context around this. The reason being that a lot of hype was there on the cryptocurrencies, and the RBI stands against that virtually having a ban or an absolute no to digital cryptocurrencies, crypto assets also. And this is the RBI stance. So the reason being, when we have an efficient payment system which is at much lower cost, why do you need to go for cryptocurrencies? And the sheer anonymity, the reason that is being used for shady transactions, it could be possible, it could be used maybe for legitimate transactions, but the anonymity, the obscurity which surrounds the entire crypto world makes it difficult and easy for it being used in murky drug deals, terrorism funding, etc. So that has set the momentum for the central bank digital currencies, and I think India has been RBI has been one of the central banks to introduce the digital currency, the central bank digital currency, in the wholesale segment, and now it is in the retail segment also. Going forward, it could be used on a larger scale, and then of course that would ease the entire payment system and facilitate it without any kind of loss in confidence, because this is central bank digital currency. It is legal tender. It is something like your rupee notes or rupee coins, which can be easily exchanged. And of course, as long as it's held as cash, it will not earn you interest. But if you put it in fixed deposits, then of course it will start earning you interest. So it's interesting to see how it develops. And the other important regulation which has come up is on the scale-based regulation framework for NBFCs. This is basically part of the RBI's gradual approach to bring NBFC regulation on par with banks, because NBFCs have grown in scale and size, And some of the larger NBFCs are almost vying with banks in terms of the balance sheet size, in terms of the business they have, in terms of their technology framework, etc. And in fact, today's ET showed a report from that credit growth has increased by around 18%. And a large share is also being attributed to the NBFC space. So this warrants a different look, different perspective altogether on the way NBFCs are being regulated. So that is why the RBI has classified NBFCs now into a base layer, a middle layer, upper layer, and a top layer. So the base layer consists of basically of non-deposit taking NBFCs with asset size of less than 1,000 crore. And while the middle layer consists of all the deposit taking NBFCs and non-deposit taking NBFCs with asset size of more than 1,000 crore. And you have the top layer, the middle layer, and also the top layer. The middle layer, RBI has now identified around 16 NBFCs, which includes Tata Sons, L&T, India Bulls Housing Finance, LIC Housing Finance, and other entities as the NBFCs which are fitting into the middle layer. The top layer would be identified by RBI, and the middle layer and the top layer is basically something which goes into the entire space when you look at it from the point of view of leverage. The middle layer was the upper layer is where RBI has identified 16 NBFCs, and then you have the top layer. So in the top layer is something which RBI will identify which will be the NBFCs. But as of now, the top 10 NBFCs and also the others identified by RBI fall into the upper layer, as they call it. And this is based basically also on certain parameters like leverage, the size of the balance sheet, the size of the interconnectedness between the NBFCs and with the banking system, with the financial system, which will determine like where they will sit in, whether it's the upper layer or the top layer. And it depends also on the perception of risk that the RBI sees in such NBFCs. And this would warrant a tighter degree of regulation. So you have the base layer with maybe a lighter touch regulation. Then you have the middle layer, which consists of a slightly stronger degree of the slightly graduated degree of supervision. Then the upper layer and the top layer, which have more of a rigor to their supervision and regulation. And this would warrant classification based on their exposures, guidelines on exposures similar to banks, NPA classification, which is almost similar to banks. And also they would have to go on CBS within the glide path, which is being set by RBI. So it is at the governance standards in terms of having the various committees, the risk management committee, regulations for the independent directors that they should not be on more than 3 companies and 3 NBFCs, etc. So the entire perspective around NBFCs will be changing. The rigor will be of supervision. Regulation will depend upon the size, the interconnectedness, and the risks that they pose to the financial system. So this is an important development in the area of NBFCs, and which RBI hopes that over a period of time this will be on par with those of banks. Now, coming to the subject of today on digital lending. Digital lending is something which is to be welcomed in the sense that fintech has made life easier for a lot of customers, lot of banks, and as they say, you need banking, but you may not necessarily have to go to a bank. But does that mean that or technology is acceptable. Now, so just because something is technically or technologically feasible, it doesn't mean that it should be accepted. There should be no regulations. The pandemic has shown that it can pose a threat. It can pose a risk to customer protection. It could affect customers in various ways. And as the pandemic showed, that there were a whole lot of population, younger population, the under 30s, many of them locked up in their houses without income, who found this easy apps which they could download and apply for a loan. No questions were asked. The traditionally, if you go to a bank, you need to have your KYC documents. They would do a credit assessment. They would determine whether you are eligible for the loan you're seeking, and then give the loan approval. But not so in the case of these digital apps, which they found so easy to access. And they all it asked was your PAN and your Aadhaar and a photograph. That's all. Nothing on the sources of income, etc. And typically these were very short-term loans. But while the ease of doing business, ease of applying for these loans was good, in the sense it was extremely easy, and many found it a boon. The pain started when they would default on this, obviously, because there was no proper credit assessment, and the people who had applied for this may not be really eligible or be able to repay those kind of loans. And then the pain started, because they could access your mobile contacts, they could access your social media profile, and it drew many to suicide. This was during the pandemic phase, but this threat still lingers. Even a couple of months back, there was an article in the Times which reported an incident of a person committing suicide because of hounding by these loan apps, the lenders. So they are alive and well. But at the same time, as the regulator, when they fintech, the stance which is taken by most regulators is you don't jump in and you create a whole series of regulations, because you want to allow the space to develop, because you know it is an important part of financial inclusion. It contributes to ease of business. It helps banks to develop, reach out the last mile. It helps the NBFCs also. So there is an advantage to it. And at the same time, killing it by over-regulation is not something which the regulator wanted. So in fintech, the regulation is not in advance. It is generally after watching how it progresses and seeing how it impacts the financial stability. In fact, if you see the pattern of lending, while China, US, and the UK lead in fintech in the space where lending is concerned, you find that in India, in 2021, about out of a total of 53.08 lakh crore, which was through the physical media, only about 1.12 lakh crore was through the digital media. So it is not so much of a major concern. But from the point of view of the scale to which it can rapidly increase, as the professor had pointed out in one of the articles, that the next crisis will happen not in Silicon Valley, it's not in Wall Street, but in Silicon Valley. Don't worry about Wall Street. Worry instead about fintech. So the rapidity by which the scale with which it can multiply, and it can affect financial stability also. So this was the trigger which made the RBI set up a working group to look into the entire space of digital lending and then frame regulations around it. And the principle in RBI has always been, it's not a rule-based regulation, but more of a principle-based regulation. And that's what we find in the digital lending guidelines, which were issued in September 2022. And coincidentally, the time given to banks, NBFCs, and other regulated entities to put in the framework of the guidelines to implement them expired yesterday. So from today, they are required to follow all the guidelines. They would have had to have that infrastructure in place. Coming to the digital lending, how is it in other countries? The immediate remark, or rather the perception, would come like in India, we are being very strict. Many things are happening which may not be happening in other jurisdictions. But if you have a look at other jurisdictions, in Germany and Australia, digital lending can only be done by banking entities. In other countries, like if you see other countries like China, you have the China Insurance and Regulatory Body, which allows digital lending to be done only within a province, depending upon certain criteria that they are required to have certain capital, have a certain and a license to operate in that particular region, that province. So there are guidelines in place. Even in Hong Kong, you have a kind of regulation and a licensing framework also. In India, typically the lending space is governed by the provisions of the RBI Act, which for banks and also for NBFCs. Then you have the Banking Regulation Act. You also have, to a certain extent, the Companies Act, which also for others which are not regulated by, say, RBI, they have framework for what, or rather limits on how much they can lend. Then you have at the states level, you have the Money Lending Act. So Money Lenders Act, which also provides for the regulations around the interest rates, etc., which can be charged on money lending. So there is a statutory and a regulatory framework already in place. But that has not been really sufficient to stem this digital lending, or rather the side effects, the ill effects of the digital lending space, particularly in the in the aftermath of the pandemic. Is significant that nearly 35% of the complaints which were received by RBI up to 2021 were against, in the sachet, were against digital lending. And this shows that there has been certain issues in their space, and which required regulation. So the guidelines on digital lending was issued by RBI in September 2nd, 2022. And this entirely centered around certain spaces. And this was basically on customer protection and conduct requirement. So the requirement under the regulations which have been issued by the RBI require that if a regulated entity wants to go in for digital lending, the disbursement, repayment, servicing, etc., should be through the bank account of the regulated entity, except in cases where there is a particular requirement for a disbursement for a particular purpose. Then it can be done into that particular account of maybe of some other bank, of a third party. But otherwise, it should not be credited to a third party account. And the concept of having a pooling account, maybe with a lending service provider or a digital lending app, that would not that is not allowed under the current regulations. So all lending, disbursement, or the disbursement, servicing, etc., repayment should take place only through the bank account of the regulated entity. That is one. And the other key factor is that so far there's a lot of obscurity around the lending space. The digital lending, the digital lenders who were unregulated were charging exorbitant amounts of interest. And very often the customer did not know what he was or she was getting into until she was struck with the repayment. And then the the recovery agents started getting abusive and making life miserable for them. So one of the things which has emerged from the suggestions of the working group is to have a key fact statement, as they call it, which gives the customer the entire kind of list of, or rather the system is absolutely transparent. What is your loan amount? What is the interest charged on it? What is the annualized percentage rate? That is the all-inclusive cost of your loan. That's the cost of funds, servicing, collection charges, the verification charges. All that is built in on an annualized basis. That has to be disclosed. What is the installment you have to pay? In fact, it suggests that you give RBI came out with a model key fact statement, which also gives you what should be the installments which are due as per the loan repayment schedule. Then processing fees, insurance charges, the net disbursement amount, tenor of the loan, the repayment frequency, number of installments, and also any contingent charges. And the regulation also says that if something is not mentioned in the key fact statement, you cannot charge it. So that's a very important from the transparency point of view. And another important point is that you have um, you have something like a cooling period in which, or a look-in period, where the customer gets a chance to see how it works, after availing the loan. Say for a 7-day loan, maybe a 1-day look period, and if it's more than 7 days, 3 days, within which time he is not charged any penal charges if he decides to exit the loan altogether. If he, after the 7-day period, maybe if he wants to exit the loan, then the normal penal prepayment charges would, as per regulation, be applicable. But in that look-in period, so it gives a lot of options to the customer now. He's not totally at the mercy of the lending service provider or the regulated entity or a digital lending app in making his credit decisions. And all these statements, or rather all the documents for sanction, etc., all should be digitally signed by the regulated entity. That's also a requirement. And there are disclosures also, like who will be the lending service provider, who will be acting as also as a recovery agent, and also the name designation of the grievance redressal officer. Both the regulated entity and the lending service providers, who are basically those who are partnering with the regulated entities, which are banks, NBFCs, etc., in providing these services to the customer, they should have their own grievance official who can address grievances, and all this has to be displayed on the regulated entities website. So the borrower has the complete information on whom to approach and where to approach. And it also says that if a complaint is not resolved within 30 days, you can approach the ombudsman, the integrated ombudsman, or at the RBI for resolution of the grievance. From the point of view of other things, product information, all this should be available. And what is also important is that this is of course standard practice for most regulated entities. You assess the customer's credit worthiness, and which is not there in an unregulated space. As it was being done, you just provide your Aadhaar and your PAN card and you get a loan. But here there's a proper process of credit assessment based on the borrower's income, occupation, and on which it can be decided. The regulated entity can take a decision on the quantum of loan to be sanctioned, and this has to be auditable, because this lends it to supervision by the RBI or the regulator, who can come on board and see whether these processes have to be followed. Technology also is also very important, because here it involves collection and storage of data. So some of the things will also be popping up in the data privacy bill, which is coming up. Here, you cannot collect more information than you require for sanction of a loan. It should be just sufficient information. And the lending service provider is allowed to store certain information at his end, which would be something like phone number, contact details, etc., which would enable them in the recovery process, but not other data, personal data, or other details like contacts, etc., are not allowed to be stored. So and all the data has to be stored in India. So that is also one of the requirements. And again, the standard practice that data should not be shared with third parties without the explicit consent of the borrower. And the customer can at any point of time can withdraw his consent also. And so it gives him the upper hand in such kind of situations, knowing what is being done to his data, having control over the data he shares. Storage of data, data privacy issues to ensure that there is no leakage of data, and etc. And it also requires the regulated entities to report all digital lending to the credit information companies. So that information is also available for entities to know also, like how much maybe the customer has availed from other companies. So the coming down, so the regulations are defined on what regulated entities can do, and there is a clear guideline that just because you have partnered with a lending service provider, and it may be a reputed fintech, you have done your due diligence, but it does not mean that you are not responsible for their conduct. The regulated entity continues to be responsible for its content. You had an instance, this is not maybe not directly related to digital lending, but Mahindra Finance was banned from using outsourced agent for recovery because there was an incident involving a tragedy where somebody drove a tractor or a lady in the process of recovery. So those strong-handed tactics made RBI prohibit that particular NBFC from using outsourced agents for recovery purposes. But they could use their own agents. So it's not a kind of a free-for-all where regulated entities can use lending service providers, outsourced agencies, and claim ignorance of what the agents are doing. So they are actively responsible for what they are doing, right from the way they use recovery, they use the data, they store the data, and also how they share the data. So it is a total responsibility on the part of the regulated entity. They are also expected to frame policies which are known and shared with the lending service provider, so they know what they are expected to do. So there's a tighter regulation around the space, and this will hopefully ensure that the digital lending space while it will be allowed to grow, and definitely help in greater financial inclusion by banks and financial institutions, empower them to increase their reach and extend credit to the last needy person who wants a loan. It would definitely has put in place clear guidelines which regulated entities know what they have to do in the space, and ensure that the clear guardrails are there, that they do not overstep their limits, that there is adequate customer protection, which is the bulwark of the entire Reserve Bank's target. And at the same time, in the overall perspective, it will ensure that there is a disciplined development in this fintech space, which would help in ensuring that there is financial stability and no ballooning, so that the next crisis really does not develop in Silicon Valley or in our own tech hubs here. So it is definitely something which is of critical importance in the fintech space, which allowing fintechs to grow, and at the same time allowing banks to partner in this. So since fintechs have got that advantage, they use a lot of they have data, they have artificial intelligence and many other capabilities which help in doing a proper credit assessment of the borrower and coming to conclusions, maybe credit assessment, sanctions, etc., or rather arriving at, say, the lending potential of or to a particular customer rather than banks. So while banks would find it difficult to scale up rapidly on their own, their partnership with fintechs would definitely help in expanding the space and ensuring that there's a healthy growth in the financial system, with credit being given where it is required with the necessary guardrails in place. I think with this, I would come to the end of what I have to say, and I would look forward to your perspectives on this from the fintech space and how you view these guidelines.
Thank you so much, Teresa. Before opening up to everyone on the call, I'll probably tap both Arnab Bhattacharya as well as Kanchan to share some of their perspectives. Just a bit of they were roped in the last minute to say, hey, share your views. You both are very experienced in this area. And just to give a bit of background, Arnab obviously has worked in banks like HSBC, Citi, ANZ, but he's also been a founder for a fairly long time. And he's now heading Savi. And he's really, really knowledgeable in this area. So I'll probably tap him for some perspectives. Likewise, Kanchan, who's got Loan Genie, which is into inclusive lending. But she's also quite, with that organization, she's won a lot of international recognition, as well as she's very, very active in the ecosystem. So, I'll tap both of them to share their perspectives on this and then throw it open to everyone. Kanchan, Arnab, any of you?
Yeah, so I was actually, I was thinking maybe Arnab will take the lead because, I would love to know what he thinks about the new lending regulations. But I would, thank you so much, Teresa, for covering the lending guidelines in so much in, detail. And what I can understand is clearly the RBI is looking to protect the interests of the consumer first and foremost, and which is also very, very, very key to all the players in the fintech ecosystem. And so it is a welcome step that so much of thought has gone into these regulations, and they have been introduced. Right from things around data coming in, because there've been a lot of data leakages happening, which have led to companies customers' data being compromised, and so those things have been taken into account. Then there are also the incidents that you talked about, which the customers were harassed, and very unethical practices being taken up by even so-called digital lenders. So they are basically spoiling the name of digital lending. But the positive part is that we have digital lending on an upswing, and Teresa and Sandhya and the viewers would be well aware that digital lending in India is just going to go up only. It is right now close to $270 billion, and it's going to it's estimated that it's going to go up to $1.3 trillion by in another 8 years, and it's going to grow at some 22% CAGR every year. So that's an exciting space to be in, and we are also having a very very interested regulator, very progressive regulator like RBI, who takes into cognizance whatever little incidents are happening, because if they are of severe, they are having severe consequences, they have to be nipped in the bud as soon as possible before a total meltdown happens. So I'm quite amazed at the ability of our regulator, the RBI, to quickly take steps so that it doesn't reach a meltdown kind of a situation. So I'm really thankful for that. But my question was, one of the questions that I had was that I was reading somewhere that basically the consumer will not be allowed to be charged the fees by the I think the lending service provider, and whatever fees that they have to charge has to be charged from the bank. So I just want to understand what is this thing really about? What is this fees are we talking about?
This is certain fees which, in terms of the recovery and other charges which that charges etc., which in clear terms the bank would have to pay the lending service provider for maybe sourcing the loans, etc., etc. A certain percentage maybe would be passed on to the customer. But then what now comes in, that is, you have that APR which lists what you can basically charge. Anything beyond that, or any other charges which they have to, if it is something which is payable to the lending service provider, that will have to be paid directly by the bank or the NBFC concerned, and it cannot be charged to the customer's account.
Right. That's helpful to know, Teresa. Thanks for that.
Any questions from those on the line?
And so while we wait for people to also put up their questions, another thing was, while the regulations are very welcome and they are clearly a step towards, anybody can see that they are a step towards protecting the consumer, the retail consumer. What I also wanted to understand was that since any kind of lending which happens, including BNPL lending, which happens, will have to be reported to the CICs, which is the credit information agencies, the bureaus, the CIBIL, etc. So I was also wondering, because of all these compliance, the things that you have to take care of, the compliance matters, it is likely that the compliance costs for people operating in the ecosystem, and especially I would say the fintechs, are likely to go up. So what are your thoughts around this?
So basically the reporting has to be by the regulated entity. So it is by the reporting to the CIC has to be done by the banks concerned. That is part of the requirements.
Right.
Can you unmute Arnav and probably Surya as well? Thanks. I think Arnav and Surya were kind of muted. They should be unmuted now. While they come on, let me share one of the fintechs that I saw last week in the lending space, which I thought was very interesting. They are actually lending to farmers post the harvest, and when the the grains are in the warehouse. So it's that kind of a bridge loan that they're giving, small value, very inclusive. And what was fascinating to me was how much that was changing the lives of farmers, because traditionally that's not a space where lending would typically happen. But here, I think I saw a consortium of banks and NBFCs which have come together for that. There was one question from Surya. I'm just reading it out because I think for some reason the audio has not yet been enabled. Arnab, I think Sai should open that up.
No, I'm on.
So,
I can speak.
okay, go ahead, Arnav. Go ahead.
No, thanks for this. A pleasure meeting everyone out here. And I was listening keenly to what Teresa was saying and Kanchan. So I think there was a question around so the new digital lending guidelines that have come into play, I think, is very clearly categorizing regulated entities, technology providers for effectively loan service providers, and they've also called a category called DLA, so digital lending applications. Now, DLAs they're not a person or an entity per se. They are more like a amorphous definition of the application that will interface with the client. So it could be owned either by the regulated entity, a bank or an NBFC, or it could even be owned by the loan service provider, right? And so what RBI, I think, has tried to do 3 or 4 things, at least from a practicing standpoint, and which we've had to deal with in terms of, changing our policies, practices, technology applications around it. Was, I think the first thing was around transparency. And therefore, you could effectively charge the consumer in various formats, right? You would charge a processing fee, an application fee, and then an interest component, and then there could be other service charges. So even though you said that your loan was for maybe, I don't know, at 1% a month, effectively it was probably coming to about 2.5% a month. So I think RBI wants everybody to be on the same page. So the APR calculation makes it very transparent. So, and typically the unit economics, because if you're lending at the smaller end of the spectrum, you're doing, really small ticket, 3,000 rupees, 4,000 rupees kind of lending for a period of 3 months. The unit economics almost make APRs work at 40%, 50% APRs with default rates of 7-8%, right? Or even 6%. Anything above 6%, you're going into a different territory altogether. So, so when we've spoken to a few people and some, people who have been closely associated, saying that you've got to go ahead and put it out that your APRs are 40%, 50%, but potentially you could go ahead and sort of make out that it's only 0.01% per day or a 0.1% per day kind of element to give people a comfort that you're not being more usurious. So I think this is a transparency element and how people in the industry are trying to work around this particular situation. I think the second aspect is that very clearly RBI sees that unregulated lending could have a blowout. So, and it could have, and you need people with strong balance sheets to sort of monitor it. So they've effectively passed on the onus of almost regulation with LSPs to an NBFC or a bank partner. So if you're a pure technology provider without a regulated entity, you'll need to work very, very closely with which anyway people do, but it's almost that the NBFC or the regulated entity are likely to get wrapped on the knuckles for any issues faced by the loan service provider to that extent. And to that extent, what they have done is that, and to your question, Kanchan, is this, what RBI is effectively saying that the loan service provider can't effectively charge the customer because, and they have referred to effectively the loan service provider works under the aegis of like a business correspondent agreement almost. So you're representing a particular bank or an entity to the client, and effectively the bank and entity should charge the client. So the debit should happen on behalf of the bank to the client, and then any fees that you collect because of your relationship as an origination partner, technology partner, the bank needs to then pay the loan service provider. So if Loan Genie could collect fees from the client earlier, RBI is effectively saying allow the regulated entity to collect and then pay the Loan Genie. And it has multiple different implications, GST, etc., service fee, cost structures. So people are sort of working through that, right? And I think the other element, I think, where RBI has been very, as correctly pointed out, was on data privacy. So they're slowly taking steps towards ensuring a lot of data localization is happening. because as mentioned both by Teresa and Kanchan, digital lending is nothing but lending using more and more discrete data points before where you're able to understand the client better, that whole holy grail of market of one, and therefore protecting data of various sorts is of high importance. And earlier there were situations where you could take the data out for 24 hours as long as it was masked and you didn't have sort of personal data points coming through, you could do it. But I think RBI is effectively saying that even that's sort of out of the window. And the onus, as I was mentioning before, has passed on to the NBFC and the bank. So I'll stop here, but I just thought I'll just add to my viewpoints out here. And I think the other piece very clearly where RBI is calling out, saying that, look, if you are in the lending business and you're underwriting and taking risk, you better get regulated and better get capitalized properly. If you're not, or you don't underwrite and you don't take risk, right? So you just become an originator or a processor of a particular service. But as long as you're underwriting and taking risk, I think RBI is saying they want to see well-capitalized entities to do it. And that causes a problem around innovation, because then effectively you're back onto the same bandwagon that you were 5 years ago, where if you didn't have enough capital, you couldn't necessarily make a meaningful impact on the credit space. But having said that, RBI does still have the business correspondent framework. They have provided the co-lending framework. They have created the categorization of LSPs and DLAs and what they could do or not do. There are certain gray areas they are working through. But all of this has been done on the back of the recommendations of the Digital Lending Association of India. And out there, you've got most of the prominent digital lenders across consumer and MSME are part of it. And they're playing a very, very strong role in terms of influencing the RBI policy. But at the same time, you can influence and recommend. RBI has its own independent point of view, and sometimes they will take A and B, but they will add their own C, D, and E to it, and which can come as a surprise, and for all of us to then scramble and trying to figure out how we operate through the new regulations. So I'll stop here, but I thought I'd just share this point.
Yeah, to add to what Arnab has said, he has definitely brought out those points regarding transparency, which again the key survey, key KSP generally gives that entire transparency to the borrower on what will be the kind of payout by him to take on a loan. And the other point is that the regulations have made the entire while it might have hampered the growth of unregulated entities, made life a little more difficult for them. It's set in a more discipline into the ecosystem, in the fintech system, in terms of partnering banks and providing that partnership which is required in the days to come between fintech and banks in providing an efficient lending system. And by using the capabilities of fintech, their data collection, their AI capabilities to ensure that lending is done in a more efficient manner. And it is also seen as something which is, while there is a risk taken by it, the risk could be lessened or rather mitigated by having a more robust system of assessing your credit risk. And the other part regarding unregulated entities which may come in the space, one of the recommendations by the working group, which may be under the consideration of the government, which is that that no unregulated entity should be allowed to function in the lending space. This is something with the regulation which government may have to work on to ensure that there are no unregulated entities in the space which do not come under any regulator as of now. That is something which is likely to come in the future.
Any idea when, Teresa? Because there's a question here that talks about the banning of unregulated lending activities act and when it's likely to come. Any sense of timing?
This is the second or third phase in which it is likely to come, because these are recommendations which government will have to act upon. Basically, because this would involve the entire process of having that framework, passing the necessary legislation, and having the enforcement agencies also. Because today you had, digital lenders being able to register here when they were banned in other countries and able to lend effectively. So they should be both a legislation and enforcement angle, and that is something which the government is required to do. And and the other point to which Arnab mentioned, which I would like to say, is that as a regulator, RBI has been very proactive, and maybe because I was with the RBI, I would be kind of holding the torch for it. But then the fact is that no regulation comes without a lot of consultation. In fact, the digital lending guidelines came with a lot of consultation with the industry bodies, and the association which Arnab mentioned. And such regulations are also put up on the bank's website for public or the stakeholders in kind of for them to share their suggestions. And then, as he said, A plus B is taken into account, and the regulator may add their own perspective to it to ultimately come up with regulations which protect the ecosystem and allow a fertile ecosystem to develop.
Teresa, there's one question which I think Surya had asked.
Yeah,
it is
I'm
about.
here.
Go ahead, Surya.
Yeah. So I came across a fintech organization which is enabling SMEs who have exhausted their credit limits of banks for bill discounting, peer-to-peer lending. So they do some kind of rating, and they rate the product, and then investors can come and choose, and the interest rate is around 14%. Is that doable, or any regulations required in this? When the payment comes, say Amazon, it goes to a escrow account, and then from there they pay it out to the investor after deducting that fees.
Yeah, so I think there is an issue around that, and I think people are seeking clarity around the same, because the idea is that the money should not be sitting in a intermediary account. It should be directly hitting the beneficiary account, and a lot of the payment gateway structures. So I don't think there's enough clarity on it.
Yeah.
Some people have stopped it from moving ahead, while other people have still sort of created certain agreements to work around it, which is effectively getting customer consent to credit an intermediary account, which will then pass on to them. So this is a gray area, Surya. I don't know if Teresa, Kanchan, if you'll have a different point of view.
So the regulations are clear that the money cannot go into a third-party account from lending. When there is a tie-up with a lending service provider, it cannot go into a third-party account or a pooling account. But in this particular case, I'm not sure how they are doing it. And as the regulations stand, this is the position. And maybe as it evolves, there will be more clarity on the issue.
Okay.
Yeah, exactly. I agree with Teresa on that. I think right now, from what I can understand, it has to go directly into the borrower's account and back to the lender's account, so not really clear about the other processes which are there, and definitely it'll take some time before things settle down. So we'll wait for that.
I think we wanted to have somebody from the bank or an NBFC also joining in on this conversation. But in the absence, I'll just kind of take a stab at one of the elements. I think if anyone is partnering with the fintechs and they are taking the onus of the risk, they do need to be very conscious of making sure that they own the risk and manage it effectively. But on the other hand, I know every bank is partnering very actively and proactively looking for partners to kind of grow rapidly and take advantage of all the opportunity that's coming in the next 7-8 years as the fintechs grow. So we have just about a minute before we wrap up. So if you have any questions, please let us know. We'll try and take them up in the next session. But if not, we hope you found this useful and meaningful, and we hope to do more deep dives into topics that will be of interest to you. Between now and end of January, you're likely to have almost 4 separate sessions coming from the FinTech team. One will be Kanchan with another founder. There will be one, which I think Santosh Kumar from Citibank is planning to kick off some workshops to get fintechs ready for pitching and growing. So we should be starting off a series of those activities. We have a blockchain leader from Germany / Silicon Valley in partnership with the IoT team, Anand, that we'll be bringing on 16th of January. And we'll have the monthly pitch day kicking off along with the TiE Angel network activity, which should be either in December or early January, which we hope will start off with at least 1 or 2 fintechs. So if any of you know any fintech who are looking for funding, please connect them to us. What we'll try and do is make sure that they're ready for the pitch, so that they can take advantage of it. Lastly, we will also be kicking off some research around green fintech and a few other areas. So look out for more of those in the coming weeks. So with that, it is exactly 6 o'clock. So thank you very much for having joined. And Teresa, thank you very much. Look forward to your next session. Arnab, Kanchan, I know it was last minute roping you in to share your perspectives, but I think they were absolutely invaluable. And I'm sure the people watching it found it tremendous.